Hey guys, Joel Frank here, market analyst for YouTrading. In today's video, we're going to be taking a quick look across markets, talking about the themes that have been in place so far this week, how markets have been responding, and then we're going to talk about the main events that are coming up for the rest of the week. Now, let's quickly just run through the charts. We'll start with the dollar index, I think, to give an overview of price action in currency markets. As you can see, we had a little rally in the dollar, but it's pretty much petered out. We have had some US data, which is potentially contributing to the weakness. So consumer confidence data on Tuesday, weaker than expected. Today's ADP non-farm employment change, which is like the first estimate before you get the official non-farm employment change number on Friday. That came in quite a lot weaker than expected. ISM manufacturing PMI also weaker than expected. So that's 3 weaker than expected data points. But then JOLTS job openings at the end of last year, 11.1 million, much higher than expected, showing that labour demand ended last year pretty strong still. So kind of a mixed picture, but more downside surprises than upside surprises, which has kept the dollar on the back foot and seems to be giving stocks some modest support. The S&P 500 fell back to 4,000, but then was able to recover back above 4,050, where it's holding right now. But the main events of the week are still to come, guys, as we already discussed in the video on Monday. Let me just go back to the calendar. Today, we've got the Fed meeting coming up at 2 p.m. Eastern time, 7 p.m. London time. Then you've got the Bank of England on Thursday, ECB on Thursday as well. Then you got US jobs data and ISM services PMI on Friday. So really massive week. In terms of how all these events are going to go down, well, we're expecting a 25 basis point rate hike from the Fed, a 50 basis point rate hike from the Bank of England, and a 50 basis point rate hike from the ECB. So that divergence appears to be keeping the dollar on the back foot for now. Like if we have a look at euro dollar real quick, you can see hanging out close to its recent highs. Sterling or cable hanging out close to its recent highs as well. One thing to note with regards to this upcoming, that's the wrong Dixie. With this upcoming Fed meeting, a lot of people have been talking about how the markets might be underestimating the Fed's resolve to firstly hike interest rates and secondly hold them at higher levels. So after this 25 basis point rate hike, which is going to take interest rates to 4.5 to 4.75%, markets are only actually pricing for one more 25 basis point rate hike. So interest rates pretty much peaking below 5% and then falling later in the year. But a lot of strategists think that the Fed might actually signal their intent. Powell later today might signal that the bank actually wants to take interest rates above 5%. And then he might push back against the idea of rate cuts later this year. So above 5% for the rest of this year. That's not what markets are pricing. That would be a shock if that was the signal that the Fed sends, which is very possible, which could support the dollar in the short term. Is it going to be enough to take the dollar out of this downtrend that it's been in now for weeks and weeks and weeks? I wouldn't be so sure about that, but it could potentially see a rally back above 102, perhaps towards resistance in the 103 area, which would obviously weigh on euro dollar, sterling, the likes of dollar yen as well, which dollar yen's in a very nice downtrend too. Potentially that could trigger a bit of an upside break of this downwards trend line for now. But I'm not betting. Well, the US economic fundamentals, as we've been seeing in the data this week, do show that the US economy is weakening faster than expected. Inflation's been cooling faster than expected as well. And many people still expecting a US recession sometimes later this year. So a hawkish message from the Fed, it's not really super credible, okay? How many times has the Fed got it wrong? They always seem to get it wrong. So whilst a more hawkish message might deter some of the dovish pricing, I still think markets will probably expect rate cuts by the end of the year, regardless of what happens with today's Fed meeting. But yes, obviously in currency markets as well, for euro dollar and sterling, we're going to need to be watching how hawkish the Bank of England and the ECB are as well. And just while we're talking about the ECB, actually, look at this number. Core CPI in the Eurozone higher than expected last month. That is going to support the argument from the hawks that they need to continue with aggressive interest rate hikes at the ECB. So that's something to bear in mind for tomorrow's ECB meeting. Let's just quickly look at a few other asset classes. What about US oil, which has been pulling back recently after a failure to get above resistance in the low 80s? This is WTI. We're still talking about slowdowns in the US economy, slowdowns in other part of the world, which for now is undermining optimism about the China reopening. Very much still a macro-driven market, which, given pessimism about the global economy, makes it pretty difficult to argue that oil should push higher to the low 90s resistance area from October and November. So I'm thinking the oil is probably going to continue to languish. Although technically speaking, it does look like we're forming a bit of an ascending triangle here. Just something to bear in mind, because this kind of technical pattern does often precede a bullish breakout. So just something to be monitoring. Gold hanging out close to recent highs. There is a risk that the Fed can trigger a bit of a pullback. We could perhaps test support in this 1880 area. But, if we're talking about a US recession later this year, we're talking about the dollar remaining in a long-term decline. We're talking about the Fed eventually being forced into a dovish pivot because of those weakening US economic fundamentals. It remains, in my opinion, hard to bet against gold in the long run. So, if we do see a more severe short-term dip, I'm thinking people are probably going to want to buy that dip. And eventually, I think gold probably will hit the 2000 mark, resistance here, up from last April, and probably test its all-time highs, which are around here. Can that happen this year? I mean, we came a long way just in January and a long way just since last October. So maybe we're not going to continue with that pace of appreciation, but there's no reason why not. But anyway, guys, hope you all enjoyed the video, and I will see you all in the next one.